Welcome to the Daily Update, where I'll go over the action in the market for Thursday, April 13th, and then we'll see how things look for Friday, April 14th. We had a pretty solid up day. Our charts were indicating that things were a lot more positive. However, as we're climbing, we are doing so on below average volume. That's something to be aware of. We're also getting to a short and even intermediate term overbought condition. Doesn't mean we have to stop here, just something to be aware of. But all in all, it ended up being a pretty positive day. However, we do have some upper resistance, not only in the S&P 500, but also in other indexes that I'll go through. Before I start in the video, please be reminded from April 22nd through May 14th, I will be traveling. I'm going to try to post the videos every day, and I'm going to try to do the other videos if I can. I do have a podcast that is a carbon copy of what you're watching right now. I do have PDFs, not only in each podcast, but in each video where you can follow along with the slides and charts. I do have a private Facebook group that you're welcome to join. There is a poll that's currently posted on the community tab. Please feel free to take part in that. I'll go over that in the weekly video. And then I'm also asking, do you want me to add chapters or zooming in to the videos? Do you think that'll help the quality of the analysis? There's also some audio issues I'm trying to take care of. So let's go back and see what happened. At the open, we did have a gap higher open and prices climbed above the daily pivot at 4104. As the day went on, we kept climbing. We got up to R1 at 4122. Because of the spread that we saw on Wednesday, there was a wide spread in the pivot points for Thursday. We almost reached R2 at 4152, just a little bit below that. We closed near the high, so all of that is positive. We were up 1.33% on below average volume. Our technicals are positive overall, but looking a little toppy right now. We also have some resistance to be concerned about. Inflation and interest rates are really what's driving the market right now, but in the background is more banking information going to come out. In Friday's session, we have a number of the big banks that will be reporting. Is that going to be taken as either good news, bad news, or more insight as to what's actually going on? Here's the intraday chart showing how we gapped higher at the daily pivot. We shot up to R1. We just kept going after that. Never made it all the way up to R2. Went a little bit flat going into the close, but we did end up closing pretty much near the high. Here's large cap growth and value, which both had a pretty good day. Here are the closing values showing how growth really did well with the large caps, mid caps, and even the small caps. Here's the 10-minute intraday chart of the SPY showing after the close on Wednesday, we did drift lower, but then things really shot up. In the overnight session, fell back down. We were pretty positive going into the open. That took prices higher all the way up to the top, and now we're drifting a little bit sideways in the initial overnight session. What are some comments that we can make? Volume continues to be below average. On a short-term basis, we have the stochastics, the Stoch RSI, and the Williams percent R giving us extreme positive readings. On an intermediate-term basis, we have the TTM squeeze, the PMO study, the Sean trend meter, that's a new addition, as well as another new addition, the McClellan oscillator. The dollar was down and interest rates were up, so that was kind of interesting. Typically, when interest rates are going up, that puts a headwind on stocks. It didn't do so in Thursday's session. The Home Builders ETF negative divergence, it's still there, but as we keep going day after day, it's becoming less relevant. The 30 to the 5 is a normal yield curve now, where our other yield curves remain inverted. Sentiment is positive at 65, where it had been at 62. Looking at our trend, we're still positive overall. The green line's on top, even though it's coming down slightly, even with the up day. But when you compare it to the moving average, it is getting stronger, but we're still below 20 overall. Our bias is positive with the up day, and our momentum, I've switched to positive to mixed. The economic reports that came out, this is what really sparked the market. The PPI came out down 0.5% on a month-over-month basis. They expected it to be up 0.1%. Last time it was unchanged. That calculates out to a year-over-year advance of 2.7%, where last time it came in at a whopping 4.9%. So we saw a real decrease that way. If you take out food and energy, we were down 0.1% month-over-month. They expected it to be up 0.2%. Last time it was up 0.2%. On a year-over-year basis, that comes in at 3.4%. Last time it came in at a 4.8% reading. Weekly jobless claims actually ticked up a little bit. It came in at 239,000 where they expected 236,000. Looking at some Isabel net charts, this is from Real Investment Advice, showing how sentiment had become pretty extreme negative when you take retail and institutional investors together, and we're starting to come up out of that. That could be a pretty significant move when you take all of this together. This chart looks at the presidential cycle as well as the decennial pattern. That's the red line. This is what's been happening so far. The yellow, dark blue, and blue line, they are both positive going up, and that could give some positive seasonality to the market. The next chart says that Fed cuts are often bearish. We've seen evidence on both sides when we're looking for this. The market is just waiting for this pivot, and then once it happens, it'll probably have a relief rally. But historically, that can also prove to be negative for the market. When the Fed started cutting rates, we went into a recession. And think about the logic behind this. Why is the Fed cutting rates? The economy's slowing down. The employment situation is looking weaker. Things are not going as good. The Fed has to stimulate the economy. How do they stimulate the economy? They lower interest rates. So just this idea that the Fed's going to pivot, lower interest rates, and the market's going to go to the moon doesn't always play out that way, even though that's the scenario the market has latched onto. This also looks at the S&P 500, which has been adjusted for inflation. This is still suggesting that we are in a secular bull market, and other charts that I show you also suggest that. How are buybacks doing right now? There's a lot of new buybacks that have been authorized going back to April 6th. That's seen as a positive sign because a company is willing to go out and buy their own stock. That decreases the number of shares on the market, and if a company is willing to put its own money on the line, that's also seen as positive. This looks at different sentiment gauges, risk appetite. What is the risk appetite for the next 30 days? It's really going down. People don't want to take a lot of risk. And then this is the expected equity market return performance over the next 30 days. It's kind of similar to the polls that I put out. They expected to be up slightly, but not much changed. This looks at inflation. The red line is the sticky price. Sticky price just applies to those things that don't change all that much. There's not really big wild swings in their prices. And after going up, it's starting to top out and could be beginning to roll over. Where the flexible price, where they're going up and down all the time, that has been continuing to drop. This chart looks at the aggregate balance sheets of the central banks, and it shows overall that their balance sheets are depleting. From this black line going to the right, that is a forecast with where they think things will head. Then looking at the blog post for real investment advice, this is an interesting chart. This is similar to the VIX. When this is going down, that means there's less volatility, and typically the market's going up. When this chart's going up, that means there's more volatility, and typically stocks are going down. Looking at this blue line here, that is realized volatility. That is what has volatility been in the past. And it has also been decreasing when looking backward. Well, the orange line attempts to look forward as to what do they think volatility will be going forward from here. And even though it's typically higher, it's still been leveling off overall. And then looking at this over a period of time, the most important part of this chart and other charts that I'll show you after this are just that CPI is coming down, showing that inflation appears to be dropping. Looking at some charts that I like to show you, this is the CPI chart that comes out from shadowstats.com. The orange line is what we were told in yesterday's report and how inflation is coming down. If you go back to how inflation was calculated in 1990, we were a lot higher, even though we are still coming down. The next chart's a little more scary. If you go back to how it was calculated in 1980, we still have inflation between 12 and 13% currently, even though it is declining compared to what we were actually told. This is another chart showing the official number for CPI and how the rate of change going back 12 months does show it going down. Month over month, we also see it decreasing. But when we look at the core CPI, it's having a tendency to turn back up slightly, even though it did decline on a month-over-month basis. Weekly jobless claims did tick back up, but they're still below the moving average. Continuing claims are starting to roll over a little bit, and they're right on top of the moving average. We're watching these two figures to see if it feeds over into the employment situation report. Edward Gardeni also had his take on CPI. He's looking at goods, things that we have to buy, how that's been coming down, even though it has ticked up a little bit recently. And then the blue line are services and how that's really continuing to go up. This chart also looks at PPI, which came out in Thursday's session. The total PPI, this is what do producers have to pay to buy things, to make the products that we then buy as members of the CPI. And overall, we're seeing a decline in those prices. This also looks at personal consumption. As inflation's been going up, people are consuming less. And this looks at consumer services based in the PPI, CPI, and PCED that we'll get later, how it's been coming down overall, but the dashed line with CPI after topping out has also been starting to decline. Looking at our charts, the Ulcer Index is still suggesting that fear is rather non-existent right now, meaning that there's real complacency. Here's the VIX, how it dropped on the up day, both with the line chart and the bar chart. Volatility continues to drop off on the VIX. The equity put call ratio also continues to drop, which has been giving some good support to stocks. Here's another fear gauge, which ticked down slightly, but overall fear is subsiding. And this is also subsiding a little bit with this other fear gauge that we look at. High beta stocks. This is a little bit of a concern. We're still seeing more of a risk-off posture. And I put that on the warning signs slide right now because if we're in a really positive environment, people would be getting into stocks. They wouldn't be jumping over and getting into bonds. Here's the condition of our trend showing the green lines on top, but it is declining slightly even with the up day. However, the ADX is above the moving average and advancing, but we're still below 20, so we're still in a trendless environment overall. The Arun is showing a little bit of improvement with the buyers up on top with the green line, showing how sellers are decreasing. Here's a look at the daily chart where we broke through this one area of resistance. We went back and broke through a high set not too long ago. And as I've been trying to point out, if we continue to go up, we might have this other resistance line that could be extended all the way across and the underside of this upward trend line converging. And we might hit price at that point. That could produce some pretty significant overhead resistance. On the bottom, we see where volume continues to be below average. The slope indicator, which had been rolling over, turned up just slightly. It's right on top of its moving average now. All of our other oscillators continue to be positive. Here's the PPO study, a relatively new study that I'm including. Longer term, we're crossing above zero, so that's positive. The intermediate term is above zero and advancing, and that's positive. And we're seeing some improvement in the short term. The Stochk RSI continues to be extreme positive, as does the Williams %R. Stochastic short term pegged at the top, also extreme positive and intermediate term, turning back up a little bit now with the longer term, but still extreme positive. The Force Index above zero and advancing. We're above all plotted moving averages. We have dots underneath with the parabolic SAR. The Swollen Trading Oscillator has turned up based on price and volume and are above zero. A little bit of a negative divergence here since volume isn't turning up quite as much. The Vortex, green line going up, red line going down. That is positive. The Sean Trend Meter is starting to get extreme positive. The Chaikin Oscillator was pretty much flat on the day even though we had an up day. A little bit of a thing to be concerned about. RSI above 50 with the 14 period and advancing. That's positive. With the 9 period, we're not extreme yet, but if we continue to go up, we will become extreme positive. This is another warning sign where the S&P is not outperforming utilities. In a good solid environment, we would see this ratio going up. It's actually going down. PMO study. We're getting extreme positive with the PMOs that are rising. We're still extreme positive with the buy signals. We're still going up with the PMOs that are above zero. The BPI continues to advance, and this is positive, where the NYSE BPI is still below 50, but showing some improvement. The Chaikin money flow is starting to trail off a little bit, but it's still positive overall. The balance of power continues to be positive and might be getting back to an extreme positive reading. With the TTM squeeze, we still have the darker shade of blue bars, but they're still positive overall. The go-no-go system remains positive. We're still well above this longer-term anchored moving average going back to the all-time high. This chart also shows that same thing. If we do start to fall, we'll be watching this level, which is at 40.74. Here's some fib levels. We've actually been able to break above this 41.23 level. If we start to fall, we're looking at 4,009, which you could kind of round down to 4,000. Longer term, we still have some upper resistance at 41.56. Also, if we fall at about 4,000. And then our really long-term chart, we have overhead resistance at 42.14. If we fall, we're looking at 40.20. Here's our quadrant chart We also have some overhead resistance above current price, just under the 4,200 level. The equal weight index, even though it's showing some improvement, is still underperforming the S&P 500. It's also borne out in this chart where we're starting to go back up slightly in this ratio. The elder impulse system for the S&P is positive. The McClellan oscillator is starting to get extreme positive. The broader range McClellan oscillator is still looking positive and not extreme. The summation index based on price and volume are advancing. We're still seeing a potential divergence with our new approach to Dow theory. The S&P is on top where we broke above this blue line. We have not broke above this line with the NASDAQ, and we're still keeping a really close eye on this double top. This is another thing that's a little bit concerning. We're seeing some negative divergence in traditional Dow theory, where the Dow's been going up, but the transports were actually down and diverging here, where the utilities are also flattening out and starting to go down. If the utilities develop some weakness, that would help the S&P, but it's not really helping it overall yet. Then also looking at this chart showing how transports are continuing to underperform the Dow. New highs, new lows, another warning sign. We had a solid up day. It looks like we're breaking out a little bit, but the new highs did not expand, and we're rolling over with the 5 period. And we're slightly advancing to flat with the 10 period. Advanced decline line, we're still seeing this negative divergence. We're breaking out based on price, but we're not breaking out based on volume. So this is another warning sign. Whereas the NYSE advanced decline line still is looking pretty healthy. The advanced decline ratio above 0, advancing with both lines. Accumulation distribution is also positive. Volume continues to drop off even though this is turning back up slightly. The money flow index is above 50 and advancing. That's positive. On balance volume turned back up, and we're still above this advancing moving average. The financials continue to show some relative weakness, and the regional banking ETF is still showing weakness compared to the financial sector. Looking at the broad range of NYSE advanced decline line, showing some improvement. The S&P is also improving. The mid caps are improving. The small caps still have yet to regain the moving average. The Dow is coming up against overhead resistance at this R1 level, but still remains positive. The diamonds have switched to positive. The NASDAQ, we're looking at this double top in the NASDAQ. We've not reached that level yet at about the 12,250 level. NASDAQ 100 also has not really broken out compared to recent price. The Qs, however, have turned back to positive. Here's the NASDAQ 100 where we were able to get above this 38.2% retracement level. Here's a chart that I've been showing all week. This is a weekly chart of the Qs, which are based on the NASDAQ 100. We came up to this resistance level, and so far we've been coming back down, and we haven't broke through it yet to the upside. The microcaps had a pretty good day. Small caps were also up, but still have overhead resistance and are also underneath their 200-day moving average. The Russell 2000 index shows the RSI crossing above 50. The MACD is still positive, but we're still below the 200-day moving average. Small caps have switched back to positive, and the small caps continue to underperform the S&P, and we're seeing a death cross with this ratio. The mid caps are above their 200-day moving average, but bumping into this pivot level and having a hard time breaking through that. However, the elder impulse system has switched back to positive. The home builders, after getting this extreme negative reading, were really going up. Maybe that ended up being a positive divergence. It just didn't look very positive at the time. But right now, we're getting back more to a normal relationship between the S&P and the home builders. The Copic curve remains on a buy signal, and the Pring bottom fissure is also on a buy signal. Bond yields were up slightly, where bond prices were down. Our long-term trend is still looking legitimate here. The MACD is above 0 and advancing. So it looks like this breakout above this downward sloping trend line for right now appears to be legitimate. An update of our possible positive scenarios. The 10-day average of the S&P highs minus the lows, we're still looking extreme, but we can get that way and stay that way for a long period of time. So you could take this as negative that maybe we're overextended, or you could look at this as positive that this is just showing some good momentum. The SWAG NYSE breadth thrust is still giving us a valid buy signal a number of days ago that we're still working off of. And these are the results looking out into the future when one of those signals is generated. On a broader range though, when we take the 5-period moving average of the highs minus the lows, we still continue to be below 0. Looking at our ratios, the Qs to the S&P did turn back up, but they're still under the moving average. Seeing a little bit of improvement with discretionary to the S&P, and we're turning back up and going across the moving average with large cap growth versus large cap value. Then our growth to value ratios, large caps showing some improvement, a little bit of improvement with the mid caps, and turning back up with the small caps. Our 50-period exponential moving average of the new highs minus the lows were still above zero. The indicator is also still above zero. The more it can stay above zero, the better this previous chart will look. The 2-year Treasury coming back up slightly with the yield, and after spiking up and coming down, that gave some support to stocks. If we continue to fall with interest rates, will that continue to give more support to the S&P 500? And then our staples ratio, we're still trying to figure out if these spikes in here are valid. That can also give some good support to the market. Our outlook for Friday, we have earnings season coming up, and some banks will be reporting their earnings on Friday. The technicals are positive, but becoming more overbought. We have retail sales coming out, as well as import and export prices, industrial production and capacity utilization, and business inventories, as well as the preliminary reading of consumer sentiment. And then we have the whole list of geopolitical events, unless something else comes flying in. It's inflation and interest rates and possible banking information that the market is fixated on. We do have one scheduled speech that will be coming out on Friday before the market opens. Looking at our stock traders almanac statistics for Friday, April 14th, the Dow is neutral to positive, only up a little more than half the time. The S&P is also pretty much neutral to slightly positive, where the Nasdaq is actually negative. It's only up 42.9% of the time. April tends to be a positive month. And then this next chart is just the yearly backdrop that's adding to our positive stance for the year overall. Here's a chart showing the green line where we're supposedly in this positive seasonality. Our scenarios, can't really go with the down one because everything's pointing up, even though we are becoming more overbought. Can't really go with the up one unless you're using the green line on the ADX to determine what you do, because we're still pretty much sideways overall. Even though the ADX is strengthening, it's above its moving average, it's still below 20. The green line is also declining just a little bit, and that's kind of strange on an up day, but it's still on top overall. The warning signs, volume remains below average. The S&P is becoming more overbought. The VIX is showing a lot of complacency. The S&P is underperforming utilities. The new highs and new lows are lagging, and that's a concern. That shows internal strength or weakness or exhaustion. The risk-off posturing is still continuing. The small caps are continuing to underperform, even though they improved a little bit. The Nasdaq may be declining from that double top. Until we break through that, we want to keep that in the back of our minds. The home builders continue to show a negative divergence, even though that's becoming less relevant. And then we have earnings season coming up with the banks reporting first. Our conclusion, the S&P is positive but becoming more overbought. That's in the short term and intermediate term. Long term, we're still positive as long as we stay above that 200-day moving average and we had a recent golden cross. Thank you. I hope you found this video helpful. I will do my best to prepare the video for Monday, as well as preparing the weekly video, intermarket analysis video, and the deep dive video. I'll get those posted just as soon as I can over the weekend. Have a great weekend, and I'll talk to you in the next video.